Let's find out more on what the investment implications are with Jimmy Koh of UOB and Mito Kotecha of Barclays. Gentlemen, thank you very much for coming in to talk to us. So, Jimmy, you're saying that all this easy money is floating around the world and it's landing right along our shores. What do you see on your FX screens right now?
You see, what happened right now is that, in January alone, 30% of global central banks, global GDP actually cut rates. By February, almost 45% of global GDP actually cut rates. But the unique part about it is that the West is still struggling with a lot of structural issues. So this liquidity that's created, they are struggling in the different asset classes. That's why we see bond yields, government bond yields at historical low levels. So this liquidity is actually shifting into our part of the world.
It's interesting that some of this money is actually not landing right along the shores of China, which is what used to happen. China is suffering from capital outflows and it's looking a little bit fragile.
See, the world right now is that if you look at the West, everybody is slowing down. And China is also trying to engineer a self-slowdown in the economy. So you find that the liquidity of the world is coming to Asia, in particular to ASEAN. Why?
Oh, really?
We saw that partly because the balance sheet of ASEAN corporates, banks, sovereigns are fine. Partly because we went through a 1998 crisis. So a lot of the balance sheet was restructured. In fact, we only started to leverage up in our part of world sometime in mid-2006, 2007. So we have not gathered that kind of fats like what you have in the West. So you find that the policymakers are erecting barriers to protect areas that have social and political implications, like, for example, housing market, etc.
Right. I mean, it is very difficult for Asian policymakers. The reality is Asia is a massive beneficiary from lower oil prices, so the region has done very well.
Agreed, yeah.
It has idiosyncratic factors. As you say, China is slowing, but India is growing more rapidly.
Right.
Certain other, Indonesia has looked more positively. There's a lot of positive factors. So it's not just money coming because of the excess liquidity in the West, but also positive idiosyncratic factors, positive relative growth outlook for Asia compared to elsewhere. But central banks are finding it very tough. They're having to resist currency gains, so they're having to build up reserves. And then there's liquidity issues by doing that.
That's
and
why
China
Asian
is
central
doing
banks are easing left or right. We saw that surprise move by the RBI. China is easing as well.
So the only thing they can do is that for areas that have social and political implication, for example, housing in Asia, every investor loves property, real estate.
It's a national pastime.
But real estate is becoming less and less of an investment class. So the cost of investment property have increased massively. So what happened? This liquidity again must find places to park. Liquidity is like water. Water at the end will find places to park. Where is it? Equity, bonds. So someone was asking me, we are going through this big rotation from credit market to equity market. I say, no, everything is going to do well. Why?
Really?
Because unfortunately, these are all
Nowhere
liquidity. Don't know where to hide.
That's right. Well, there is a counter argument as well, in the sense that this year we will see the Fed hiking rates.
Right.
So, there's obviously a lot of liquidity in Japan. We're actually looking for another round of QE in July, with ETF purchases by the Bank of Japan. ECB, we know they're going to start very soon.
Dollar yen is already at 120, so where does it go?
Yeah,
I thought it's factored in. I mean, does it shoot up to 150? Does that mean that Nikkei goes back to the days of 20,000, 30,000?
Well, if we're right, the Bank of Japan will enact more ETF purchases, so equity linked, so equities should do well in that environment. But the yen, a lot of policymakers in Japan now are actually worried that the yen has gone too far.
Right.
Our own valuation measures suggest that the yen is overly cheap here. So actually we don't look for dollar yen to move significantly higher from these sort of levels in any case. But yes, I mean, Japan is going to be a liquidity provider, as is the ECB, at a time when the Fed starts hiking rates, possibly by the middle of this year. So I think we're going to have a lot of divergent monetary paths as well.
It seems like really the race is on over who really moves faster.
There are basically the three more dominant safe haven currency of the world, which is yen, because of current account surplus, which is the Swiss franc. So liquidity was coming to the other safe haven called the Sing dollar. What they want to do is to mitigate the effect of this liquidity by all these barriers. But at the end of the day, we all know money must find some place to park.
We haven't seen that much of a gyration in terms of the Sing dollar, but do you see that on the way? What's your call?
We're probably going to see Sing dollar at least about 140 by the end of the year, or even possibly higher.
140, and very quickly, Mito, what about your China, the Chinese yuan call?
Yeah, we're actually more bearish on the yuan. We've been one of the more bearish forecasters that, we're looking for a further depreciation from these levels. 640 is our forecast. So again, there's more downside. We've had a long dollar CNH trade on for some time, and it seems as if investors are really starting to move the other way as well. So I think there's definitely more downside. Now, whether there's going to be an imminent band widening is another question, but I certainly believe dollar-China fixings will move higher in the coming weeks.
Really appreciate it, Jimmy. Thank you for your time. Jimmy Koh of UOB.